Are you prepared to lose half of your investment portfolio in the next market crash? Most investors believe long-term investing is enough protection, but when the market drops 50%, they panic, sell at the bottom, and wipe out their wealth. I've studied decades of market history to show you that crashes aren't disasters. They are buying opportunities if you have the right plan. In this video, I will teach you exactly how to build an emergency fund, automate your investing, and diversify your portfolio to turn market crashes into your biggest profit-making events. If you're tired of being a victim of the economic cycle, tell me, what is the single biggest fear keeping you up at night regarding your portfolio? Let's comment below and fix it. Below and fix. Point 1. The mathematical gravity of wealth. The financial industry loves to talk about compounding as the eighth wonder of the world. They show you beautiful, smooth upward curves in a PowerPoint presentation, but they rarely discuss the fragility of that curve. Compounding is not a magic wand, it is a high-performance engine. And like any engine, if you throw a wrench into the gears at 100 miles per hour, the entire machine disintegrates. The average investor understands growth, but they are blind to the mathematical gravity of loss. Let us look at the raw data. Imagine you have built a $10,000 portfolio. In year 1, you achieve a respectable 10% return, bringing you to $11,000. In year 2, you repeat this success, reaching $12,100. You feel invincible, you feel like a genius. Then year 3 arrives, the great filter. The market corrects by 40%. Most people think, I am down 40%, so I just need a 40% gain to get back to where I was. This is the lie that keeps people poor. When you drop 40% from $12,100, you are left with $7,260. To get back to your peak of $12,100, you do not need 40%. You need a 67% return. This is the asymmetry of loss. It is a fundamental law of financial physics. Gravity is stronger than lift. For every dollar you lose on the way down, you need to work twice as hard on the way up just to return to zero. The system is designed to trap the average person in this cycle of 2 steps forward, 1 giant leap back. The elite understand that the goal of the game is not just to win, it is to never be forced to stop playing. When you interrupt the compounding process, you are not just losing money, you are losing time, the only asset that cannot be replenished. Ask yourself honestly, are you building a fragile glass house that will shatter at the first sign of a storm, or are you constructing a stone cathedral? Most of you are currently gambling under the guise of investing. If you want to join the 1%, you must stop obsessing over the highs and start mastering the lows. Point 2. The great filter and the illusion of stability. Market crashes are treated by the media as once-in-a-lifetime catastrophes. This is a deliberate tactic to keep you in a state of reactive fear. In reality, market downturns are as predictable and necessary as the winter. Since 1980, we have seen a clear pattern that the 1% uses to their advantage. First, we have the correction, a 10% drop from recent highs. Statistically, this happens every 1.2 years. If your heart starts racing when you see a 10% dip, you are not an investor, you are a tourist. Corrections are merely the market exhaling. They are a healthy reset, pruning the weak hands and overpriced assets. Second, we have the bear market, a decline of 20% or more. Since 1932, these have arrived like clockwork every 4 to 5 years. They last, on average, about 10 months. Contrast that with bull markets, which last over 3 times as long. The math is clear. The sun shines more than it rains, but if you do not have a roof, you will still drown. Third is the full market collapse, a 30 to 80% wipeout. Think of the dot-com bubble in 2000, the 2008 financial crisis, or the 2020 liquidity shock. These are the moments where the herd is slaughtered. Yet these are also the moments where every major fortune in history was cemented. The elite do not ask if a crash will happen, they ask when. They understand that the market is a machine that transfers money from the impatient to the patient and from the unprotected to the prepared. While the average person is watching the news in horror, the visionary is looking at the scoreboard. waiting for the assets they desire to go on a 50% clearance sale. I want to pause here. Every one of us has a memory of a time we let fear dictate our financial choices. Maybe you sold too early, or maybe you were too afraid to buy when the world was ending. It is time to let that go. Share your story in the comments. What was the moment you realized the system was rigged against the unprepared? Let us turn those scars into our collective armor. Point 3. Building the fortress. 3 laws of anti-fragility. To survive the great filter, you must move beyond advice and adopt laws. These are the 3 pillars of the channel investment architecture. Law 1. The survival armor. Most people view an emergency fund as a boring chore. The elite view it as a war chest. We are not talking about a few $1,000s for a rainy day. We are talking about 3 to 6 months of full living expenses locked in a high-yield vault. This is your insurance against the asymmetry of loss. Why? Because market crashes do not happen in a vacuum. They often coincide with job losses, business failures, and systemic crises. If you do not have a war chest, you will be forced to sell your investments at the bottom to pay your rent. This is the ultimate sin of investing. You are killing your compounding engine at the exact moment it needs to be running. A war chest is not about the 4% interest it earns. It is about the millions of dollars it saves you from losing by allowing you to stay in the game. Law 2. The relentless siege engine. Enter dollar cost averaging, but not the way the banks explain it. Think of it as an automated siege engine that never sleeps. By investing a fixed amount every 2 weeks regardless of the headlines, you turn the market's volatility into your greatest ally. When prices are high, your engine buys less. When prices crash, your engine automatically buys more. Imagine a stock trading at $20, your $200 buys 10 shares. The market collapses by 50%. That same $200 now buys 20 shares. You have effectively doubled your accumulation rate while the rest of the world is paralyzed by fear. You are not timing the market. You are mathematically forcing a lower average cost. But there is a catch. You must automate this. If you have to click a button to buy when the news says the world is ending, you will fail. Your biology will betray you. You must remove your hands from the controls. Let the machine do the work while you focus on your craft. Law 3. The geometric defense. Diversification is not about owning many things. It is about owning things that do not move together. If you own 10 different tech stocks, you are not diversified. You are concentrated in a single point of failure. A portfolio is built across dimensions: U.S. equities for growth, international markets for breadth, bonds or cash equivalents for stability, and perhaps real assets for inflation protection. This allows for the master strategy, rebalancing. When tech crashes 50% but your bonds remain stable, you sell a portion of the bonds to buy the tech. You are mathematically forced to buy low and sell high. This is the opposite of human instinct. It is a geometric defense that ensures your compounding engine is always fueled by the parts of the economy that are recovering. Point 4. Biological treason. The enemy within the greatest threat to your wealth is not Jerome Powell, the Fed, or a housing bubble. It is the 3-pound organ between your ears. We are all victims of biological treason. Your brain evolved on the savannah to prioritize immediate survival over long-term gain. This is known as loss aversion. Psychological research, including the work of Daniel Kahneman, proves that the pain of losing $1,000 is twice as intense as the joy of gaining $1,000. When you see your portfolio turn red, your amygdala screams at you to stop the pain. It demands that you sell. Consider the legend of Peter Lynch. During his tenure at the Magellan Fund, he averaged a 29% annual return. He was a god of Wall Street. Yet, the average investor in his fund actually lost money. How is that possible? Because they behaved like sheep. They bought in when Lynch was on the cover of magazines and they sold in a panic during the slightest correction. They let their biology override the math. To be a visionary, you must accept that your instincts are calibrated for a world that no longer exists. You must replace your gut feelings with a written manifesto. a document that dictates exactly what you will do when the market drops 20, 30, or 50%. When the storm hits, you do not think, you execute the plan you wrote when the sun was shining. Wealth is not a reward for intelligence, it is a reward for temperament. Point 5. The hidden data of recovery. The system thrives on the fact that you do not know the numbers. They want you to believe that staying out of the market during a crash is safe. The data tells a different, much more brutal story. J.P. Morgan conducted a study on the S&P 500 over a 20-year period. If you stayed invested the whole time, your returns were solid. But if you missed just the 10 best trading days, only 10 days in 2 decades, your total return was cut in half. If you missed the best 30 days, your return went to 0. Here is the kicker. The best trading days almost always occur within 2 weeks of the worst trading days. They happen in the middle of the crash. If you sell to wait for things to settle down, you will miss the recovery. And because of the asymmetry of loss we discussed earlier, missing that recovery is a death sentence for your compounding. Look at 2008, the market dropped 57%. It was a bloodbath. But those who kept their siege engines running, buying $500 a month at the bottom, were buying shares that would triple in value over the next decade. Look at March 2020, a 34% drop in 5 weeks. Those who sold at the bottom missed a full recovery that happened in just 5 months. The market is a giant poker game where the house always wins against the person who folds too early. The house in this case is the 1%. We are the ones who stay at the table when the stakes get high. We understand that the red numbers on the screen are not losses, they are a discount on the future. Wealth is a game of endurance, not a game of speed. The world wants you to believe that you need a complex strategy, a secret tip, or a high-frequency trading bot to get ahead. They want you to feel small so you stay dependent on their systems. But the truth is much simpler and much harder. You need a fortress-like infrastructure and the iron will to leave it alone. You must view yourself not as a consumer of financial products, but as an architect of a multi-generational legacy. A crash is not an ending. It is the ultimate test of your design. If you have built your war chest, automated your siege engine, and mastered your biological treason, then a market collapse is the greatest gift you will ever receive. As for those of you still watching, those who have the discipline to reach the end, here is a hard truth most will never tell you. The most dangerous time to invest is not when the market is crashing. It is when the market is at an all-time high and everyone is smiling. That is when the risk is highest and the rewards are lowest. The safest time to build a fortune is when the streets are silent and the headlines are screaming. True wealth is bought with courage, not just currency. If you are ready to stand with the builders and the visionaries, I want you to leave a very specific mark. Comment the words, "I am awake" below. This is our secret password, a signal to the community that you have moved past the illusion of the retail herd and are ready to execute at an elite level. If this manifesto provided you with real value, perform a horizontal exchange. Hit the like button and share this with one person who is currently blinded by the system. Subscribe to continue your evolution. The path to freedom is narrow, but the map is right here. If you want to see exactly how to construct your diversified portfolio from the ground up, click the video on the screen now. The fortress does not build itself. Start now.